Good afternoon. Welcome to Wealth Planning's webinar, Protecting Wealth Across the Generations. Following Labour's first budget on the 30th of October, Wealth Planning aimed to offer some practical advice and guidance to families wishing to maximise the wealth that is passed down to the next generation. To start with, I'll invite my co-host to introduce herself.
Good afternoon, everybody. My name is Rebecca Barrett. I'm a Fellow of the Personal Finance Society and a Chartered Financial Planner within the Wealth Planning team here at JM Fin.
And I'm Simon Wong. I'm a Senior Wealth Planner. I'm also a Fellow and Chartered Financial Planner. So the agenda for today is to discuss the budget changes that might affect estate planning, what to consider when planning your inheritance tax strategy, options to potentially mitigate against inheritance tax on the value of your estate, lifetime gifting, and how to strike the right balance to leave yourself with enough to live on. And then we'll finish off with some case studies.
So, budget changes that may affect estate planning. The current tax-free thresholds will be frozen until 2030. This is an additional 2 years than under the previous government. The nil rate band will remain at £325,000 per person. The residence nil rate band will remain at £175,000 per person. For a couple with an estate less than £2 million and leaving their house to their children, there is £1 million of tax-free allowances. For the residence nil rate band to continue, it will be clawed back at a rate of £1 for every £2 where the net value of the estate exceeds £2 million. For disposals made on or after the 30th of October, capital gains tax will rise to 18% and 24% for the lower and higher rates, respectively. Capital gains tax needs to be considered when gifting assets away, gifting second property, and selling second property.
So in relation to, sorry, I can't see this. So what's happened in the budget is they're looking to tax unused pension funds as of the 6th of April 2027. And pension administrators will have to report and pay any inheritance tax due on pensions. The tax-free cash that people will get, if left within a pension scheme, will therefore be subject to 40% tax. So it's a good idea for the original pension members to use the tax-free cash in their lifetime. Only the original pension member can access the tax-free cash. Having said that, careful planning of when the tax-free cash is accessed is a good idea, because whilst the pension is in a tax-free environment, no income tax, no capital gains tax, it's likely to grow at a much faster rate than if it was removed outside of the pension. And unless you're looking to gift the tax-free cash away or spend it, arguably you should try and keep it within the pension for as long as you can. And another aspect of the pensions being taxable to the estate is that it can also affect the residence nil rate band, in that if the value is added on top of the estate and is over £2 million, then you start to lose your residence nil rate band. Another change in the announced is in relation to the business property relief and agricultural property relief, where the tax relief of 100% is now capped at the first £1 million. So this really affects farmers or businesses where they're trying to pass on assets to the next generation, whereas before there'd be no tax. The first £1 million is not taxed, but anything in excess is taxed at 50%. So the excess would face a 20% tax liability. You also have now a tax on the non-listed investments, such as AIM shares. So it's now 50% of the relief. So what was 0% inheritance tax is now 20%. And AIM shares can't make use of the £1 million cap.
So what to consider when planning your inheritance tax strategy? The first thing to think about is yourself. Do you have sufficient funds to live off for the remainder of your life? Have you worked out your annual expenditure? Have you left yourself a cash buffer? Have you thought about unforeseen circumstances? If you have, do you have surplus income or capital that you might like to give away? Do you have emergency funds available? And are you in good health? Is there longevity in the family? You don't want to give away too much too soon. Are you utilising annual exemptions? Every individual has £3,000 of capital they can gift per annum, which is immediately exempt from inheritance tax. You can go back 1 year if you haven't utilised that. Charitable gifting is also an effective way to provide income tax relief, but also can reduce the overall inheritance tax paid on your estate. And finally, future changes in tax legislation. While it's very difficult to plan for, obviously any changes in future government and tax legislation may affect your overall planning.
So on this slide, we consider options to mitigate against inheritance tax on your estate. But what we tend to always recommend is, if you can, try and gift assets away to individuals, either capital or income. It's the simplest thing to do. It avoids the complications of legal and accountancy when it comes to trusts. If you can't gift assets away to individuals, maybe because they are too young, or maybe they're in a precarious position of maybe a divorce is on the horizon, then you can look to make lifetime gifts into trusts. In terms of gifting, Rebecca will talk about gifting and the rules relating to that in the next slide. We also talked about investing in assets which qualify for business property relief and agricultural property relief. As I mentioned, they are now restricted to £1 million, and then anything in excess of that has relief at 50%, so 20% tax instead of 40%. You can make charitable gifts either in your lifetime or within your will. You can also, if you've got any life insurance products, put these products into trust. They'll ensure that if there's a death benefit paid out, then the death benefit is outside of the estate and doesn't form part of the estate on death. Something that some clients are looking into is equity release. We always say that with property, your home, it should be the last resort when it comes to accessing funds. But the idea is, if you can have a debt against the estate and the amounts are liquidated, the capital's given to you, you can actually gift that money away or spend it, but it will help to reduce the value of your estate. You can also look at setting up will trusts. These are trusts which are within your will and are created on death. And the idea with a nil rate band will trust is that you can gift up to the nil rate band on your death into a trust. The nil rate band trust is a discretionary trust. It allows a surviving spouse or civil partner to access those monies. It also might allow beneficiaries to also access those monies. But the the idea is the nil rate band thresholds aren't increasing, and if they can be preserved by putting it into a will trust, the actual underlying trust assets might grow in excess of the nil rate band, and therefore be of some benefit to individuals 10, 20 years down the line. And finally, there's the idea of, for those who have assets of £1 million plus, which are surplus requirements, they could look at a family investment company. These are structures marketed by solicitors, accountants who specialize in this area. And the idea is that it avoids a lot of the negatives surrounding trusts and can be a way of people shielding future monies outside of their estate for the next generation.
So lifetime gifting of capital and how to strike the right balance. An example of lifetime gifting are potentially exempt transfers. These are gifts of capital with no tax due up front and to which the 7-year rule applies. If you are to survive 7 years from the date of making the gift falls outside of your estate for inheritance tax purposes. If you were to pass away within that time, it would fall back into your estate. Now, gifts subject to inheritance tax, i.e. gifts that are made in excess of your nil rate band of £325,000, benefit from something called taper relief, which happens 3 to 7 years prior to death. It's important to consider your future expenditure. None of us know if we will need to go into care or for how long, but it is important to try and factor that into your future planning. And of course, once gifted, cash is very difficult to recover. Normally it's been invested or spent.
So on to case studies now. And the first case study is a typical situation where we have in this case, husband and wife. They have a son and daughter, and there are grandchildren from Bob's side. So 3 generations, and there's a home of £750,000, joint savings and investments of £750,000, so 1.5 in total. There's a whole life insurance in place, set up in trust, which will pay out £200,000 on the last of Adam and Anne deceasing. And there's also a private pension in place, Adam's private pension. So what happens on death? If we analyze the position on death for, say, in Adam's case, being older, there's no inheritance tax should he leave his estate to Anne. And should his private pension also leave is not, and so, and if the private pension has also Anne nominated, all those assets go to Anne. So there's no inheritance tax because you have the spousal exemption that takes place. But if Adam and Anne were to die shortly after each other, then there would be an inheritance tax position. In this case, the value of the estate is added up, so 750 of home plus 750 of joint savings and investments makes 1.5. We now have to consider the private pension of £600,000. So that's added on, and that gives a total of 2.1. So there's suddenly a situation where not only is there an increase in the estate that's subject to inheritance tax, but also it's over £2 million, and there is a reduction in the residence nil rate band as well. So what to do in terms of trying to minimize the overall tax? Well, arguably, one should look at making gifts along the way. As I mentioned, it's the simplest thing to do. And of all the assets that Adam and Anne have, the joint savings and investments is the only asset which can be passed on in Adam and Anne's lifetime. The private pension, because it's in Adam's name and was built up using Adam's earnings and tax allowances, that has to stay in Adam's name for as long as he's alive. So arguably what you could do is look to gift away, say, the value of the private pension, but using the savings and investments. So basically giving away £600,000 of joint savings and investments. And if there's any concerns about longevity, those could be given away from Anne's name so that she can make use of the 7-year pet in her name. The consequence of doing so would be that the chargeable estate reduces down to 1.5 again. And so in that situation where the estate is 1.5, you've got 2 lots of the nil rate band of £325,000, which gives 650. You've got 2 lots of the residence nil rate band of £175,000 each, or 350. So that's your £1 million of nil rate bands. It means therefore that only £500,000 is in excess of the nil rate bands. Tax on £500,000 is £200,000. And so we've managed to get back into a situation where the whole of life in trust is able to cover the liability. So that's the first idea, is to make gifts of the joint savings to bring the pension value, estate and pension values down again. There's also a consideration in terms of with the private pension being inherited by Anne on first death. As I mentioned, there's no inheritance tax for a surviving spouse or surviving civil partner to inherit a deceased spouse or civil partner's assets. It's important to ensure that the pension is going to Anne in the foremost, but you might also want to consider having some elements which go to Bob and Brenda as well. So you can nominate, for example, that Anne has 98% of the pension and that Bob and Brenda are nominated and they get 1%. The reason to do this is in the event of Adam and Anne dying soon afterwards or together, the pension would then be passed on to Bob and Brenda. Because of the nominations. If Bob and Brenda weren't nominated, then what would happen is the trustees would have to decide who to give the money to. They would give the pension monies, I guess, to Bob and Brenda based on maybe the will. But importantly, Bob and Brenda would actually receive the inherited pension less 40% tax, because obviously there's inheritance tax in relation to Bob and Brenda. They'll receive that less inheritance tax, and it will be paid as a lump sum. So in this case, £600,000, 40% tax deducted would be £240. So basically £360,000 would be left within the pension pot. If Bob and Brenda receive 180 each, and it's received as a lump sum, then that lump sum will be taxable in 1 year. So it'll be seen as income in that 1 year, and there'll be quite a lot of tax at the highest rate of 45% that Bob and Brenda would have to pay. So it's very important to nominate children or grandchildren even, when it comes to pensions. And talking about grandchildren, if the grandchildren, Chris and Connie, were added as 1%, and Adam and Anne were deceased to die at the same time, then they could utilize hopefully their personal allowance, their tax bands, to minimize the tax that would be paid to them, the tax that would be arising, should they start to receive an income themselves. So one of the benefits of receiving an inherited pension is there's no minimum age to access that inherited pension. And so if the grandchildren were of school age or university age, and they wanted to use the pension to pay for school fees or university fees, they could do that. And it's quite likely that they'll be able to utilize their personal allowances to hopefully pay very little, if any, tax at all.
Case study 2. So this is Joanne. Joanne is a 75-year-old widow. She has a home valued at £1.2 million, investments of £500,000, and cash of £500,000. Joanne has a state pension that she receives income from and income from the investments. On Joanne's death, she will receive the transferable nil rate band from her late husband and the transferable residence nil rate band. That will total £1 million of allowances. Now, Joanne has two main objectives. The first is to reduce inheritance tax, and the second is to increase her income. So our first recommendation is an inheritance tax portfolio. We recommend Joanne invest £100,000 into this. That's approximately 10% of her investable assets. As Simon mentioned earlier, investments into AIM shares, once held for 2 years and held on death, receive a 50% relief from inheritance tax. That provides an effective rate of 20% rather than 40%. The second recommendation is an investment into a discounted gift trust. This can be a very useful vehicle for individuals who do not want to lose access to all of their capital, but would like to try and mitigate inheritance tax where possible. In this example, Joanne invests a lump sum into an offshore bond, which is then wrapped into a trust. Now, the offshore bond allows Joanne to take 5% per annum out of the capital invested that is tax deferred. So that immediately provides Joanne with income for the rest of her life. The discount is due to medical underwriting. And in this scenario, Joanne is able to invest £400,000, which is then discounted down to the value of her nil rate band, £325,000. The discount of £75,000 is immediately exempt from inheritance tax, and any growth within the bond is also immediately exempt from inheritance tax. After 7 years, the £325,000 will also be outside of Joanne's estate for inheritance tax. So in this scenario, what we've done is not only reduce Joanne's inheritance tax liability after 7 years, but we've also given her more income for the rest of her life. In addition, initially her residence nil rate band was actually tapered down because the value of her estate was over £2 million. And now with both of these recommendations implemented and 7 years passing, the residence nil rate band will actually be fully reinstated. And therefore, in this scenario, we've managed to save Joanne £220,000 worth of inheritance tax.
Okay, so we're on to questions and answers. We've had a number of questions sent in prior to the webinar. So the first to start off with is, I'll just go through questions. Specifically, in the event of my death, can I still leave both of my pensions to my wife free of inheritance tax? And what happens to them on a second death? So I talked about in case study 1 how a deceased spouse can pass on a pension to a surviving spouse or civil partner. There's no inheritance tax on that value because of the spousal exemption, civil partner exemption. So yes, there's no issue there, and the wife will then be able to take an income from the pension as normal. In the event of the surviving spouse or civil partner deceasing, then the pension can be passed on to beneficiaries, but there would be inheritance tax of 40% on that value. So in this case, the pensions would be reduced by 40%, but it would then be passed on to whoever's nominated, maybe children, or as I mentioned before, grandchildren. And so yes, there is the ability to pass on both not only to a surviving spouse, but on the surviving spouse or civil partner's death, onto children or further beneficiaries.
Next question. Can I gift my house to my children and still live in it? If you are to gift away your house and for it to be legitimate for inheritance tax purposes, you cannot continue to benefit from the gift. You can still live in the house if you are prepared to pay market rent. Otherwise, this will fall foul of the gift with reservation of benefit rule.
The next question. So this is to do with, as we discussed, gifting away sufficient or gifting away, but leaving sufficient monies for yourself later on. And one of the concerns that is quite high on many of our clients' minds is the cost of care. So this question is, how much do I need to pay for care? Well, the average cost according to carehome.co.uk is £73,000 per annum. And what we tend to find is that, say, someone who goes into a care home might require 2 to 5 years of residency. So it's a good idea to understand the cost of care within your locality, and to maybe set aside around about 5 years of care home fees for that purpose.
Can I place my house in trust to avoid inheritance tax? And are there any implications? By placing your house in trust, the 7-year rule still applies. Now, depending on the type of trust, there might be entry charges, periodic charges, and exit charges. In addition, one of the conditions of the residence nil rate ban is that the property must be left to direct descendants. So depending on the beneficiaries of the trust, the residence nil rate ban may not be available.
Okay, next question. Should I set up an asset protection trust or a living trust? Unfortunately, there's a lot of unregulated advisors who are marketing asset protection trusts in the UK. And they've made millions from mis-selling these trusts based on false promises. Age UK has gone on as far as describing these mis-sold trusts as worthless pieces of paper. We would recommend that clients seek help from a qualified solicitor and ensure that they get professional advice. Simply speaking, if it sounds too good to be true, it probably is.
Next question, what is and isn't exempt from inheritance tax? So normally, life policies held within trust are exempt from inheritance tax. And as it stands, and up until April 2027, pensions are also exempt from inheritance tax. As mentioned, investment into business relief assets, assuming they've been held for 2 years and are held on death, they will receive a relief of 50%, making an effective rate of 20% rather than 40% of inheritance tax. Generally, assets like property, cash, ISAs, general investment accounts are all subject to inheritance tax at 40%.
And the last question that we have, when should I start thinking about IHT planning or inheritance tax planning? Everyone's different. It broadly depends on your circumstances, life expectancy, expenditure, income, etc. Based on a standard life expectancy of a male and female, we tend to see individuals in their early 70s start to consider inheritance tax planning. But as I mentioned, you can look at, for example, whole life insurance on a joint life second death basis, the sort of life insurance in trust idea. And people tend to look at those from their sort of 40s and 50s when they're in better health and the premiums are lower. So thank you very much for joining us in our webinar. We do offer advice in other areas such as retirement planning, wealth structuring and protection, long-term care planning as well. If you want to have any further information on what we can do, you can contact your investment manager or email the marketing team on marketing@jmv.com. Also on our website, we have available a number of reports that you can download, and hopefully that should be of interest to you there. And so I think we've now finished. And so thank you very much for joining our wealth planning webinar, and hope to see you next time. Thank you.